Well, let's try and make sense of this madness in the markets and take it across to Nikunj. He's got Navneet Munot joining him to chat about the markets.
Right. Hello and welcome to a new edition of Market Makers. It's been a gut-wrenching fall for Indian markets, and in last couple of days the fall has been nothing short of straight line. How should one read into this straight line fall? Are concerns of liquidity, at least in the debt market, are they real, or the selling is largely sentimental and liquidity driven? Is it a time to put money to work, or for the moment one is better off sitting on cash, putting money in debt and liquid funds, because in the run up to the election market volatility is going to be high? Is good news giving you good price, or there is a challenging environment which is here to stay? So to discuss all that and much more, I have with me Navneet Munot, Executive Director and CIO with SBI MC. Navneet, fantastic to have you back. Thank you for joining us.
My pleasure.
What's going on? It's been a gut-wrenching fall. It's been a straight line fall. If I look at the screen and suddenly when I see a Nifty 50 stock like India Bull Finance crash by 30-40%, it reminds you of 2008, 2013.
So maybe I think we discussed at the beginning of the year that this is not going to be a calm and peaceful year like 2017. It's going to be a lot more volatile, and also particularly down the capitalization curve will have more pain. So if you see the market YTD, Nifty is up around 7%, Sensex is up around 7%, Nifty up 4%, BSE 100 maybe 2%, BSE 500 negative, mid cap minus 14%, small cap minus 20%. This is a mirror image of what has happened in last 3 or 4 years, and I think that was writing was on the wall. Particularly on the sector that you talked about, I think let's take a step back. Last few years, what really happened? What led to the massive growth in the non-banking finance sector? You have 3 balance sheets in a country: government, corporate, and households who borrow money. Government was deleveraging because they wanted to reduce the debt to GDP. Corporates were deleveraging for a variety of reasons. The household balance sheet was in a great shape 3-4 years back, which could take the leverage. And other factors, the formalization of the economy, the digitalization, ample liquidity helped the non-banking finance sector. Banks had their own set of challenges. A large part of the banking sector, some are in PCA, some are in different kinds of trouble due to the stress asset resolution. So there was a huge space for the non-banking sector to grab that. But in finance, I've seen over the years that whenever the growth is much faster in a particular segment, some problems crop up. And so when some of the finance companies, they took leverage which was much higher than what they should have taken relative to the asset quality that they had, we have seen some bit of problems arising. And that has happened because liquidity was ample for last few years, and they were a big beneficiary. You borrow short term, you lend long term, there is a huge spread to make, and now suddenly liquidity has tightened because of rupee, because of variety of other reasons, and then rates have moved up, and then you are in trouble when you have to roll over those maturities. And then this whole episode of a AAA rated entity defaulting, and then it just complicated the situation. Going forward, my sense is that in last few years, people who could grow the asset side faster were commanding a premium. I think now people will realize the value of the liability side. Who's got better liability franchise? Some of the banks also, I think they will grab the market share back which they have lost in last few years.
That's a great point, because in a country like India, growth is unlimited.
Yeah.
If you're a good NBFC or a good bank, you can always raise capital. The third part, which is the liability, it's only when the tide turns you find out who's been doing the wrong things. Okay.
So as Buffett said that, and I know when, I mean maybe in few months, few
so have you sold all your NBFC stocks?
And I think as Buffett said in 2008, when the tide turned, we knew that everybody was swimming naked. And I think again something similar can be said, that when the tide turns, we'll see that how many probably segments or how many people in the market were swimming naked.
So the tide has just turned. Do you think we will see more and more skeletons out of the cupboard? And are the headlines for NBFC companies or NBFC sector per se, will that only get uglier and uglier going forward?
I don't think so. Two parts to it. So few years back, if you remember, we used to discuss that how the formalization of the economy digitalization, differential regulation, and also the disintermediation is a structural trend where savers come to mutual funds, the borrowers go to the non-banking sources. These are structural trends. And in India, a large part of the informal lending, informal borrowing which was there is now moving to the formal channels. Not that banks can get the entire, can serve all the segments. There would surely be a lot of space for the NBFCs who are more agile, who have invested a lot more in technology. I think particularly those who have managed their balance sheets well, who are very good in their risk management, whether it's the credit risk assessment, whether it's the recovery mechanism. I think those people with a stronger parent, they will do well. They will continue to do well because, as you said, I mean, in India we are still starting from a very low base in terms of debt to GDP across all segments. So I think there will be space, but I think maybe the boys versus men will get probably.
How, as the AMC, you are positioned in financials now?
So both on the debt and equity sides, we have been cautious. As I mentioned earlier, that I think the liability franchise, which wasn't as important in a period where you had ample liquidity, which also got amplified after the demonetization. So I think it was your ability to grow the assets faster was more important. I think we have diversified a lot more. I think today we are focusing a lot more on those stronger, I mean the NBFCs or banks with a stronger balance sheet and a stronger liability side. And of course, it goes without saying that you have to have very strong standards on the underwriting and on the risk management.
So what happens to typical retail dominated banks like an HDFC Bank or a Kotak Mahindra Bank, or perhaps a retail dominated NBFC like Bajaj Finance? Because we may argue that retail is where the growth has come in, but retail is where, Navneet, so far the delinquencies have not been there. CIBIL and other risk management systems are ensuring that the retail borrower is not being able to default.
So this is the mistake that people make. Okay. If you go back in history and check, as I said, 3 balance sheets that borrow money, any time where there is excessive growth on the one side, that leads to a trouble. So in 2008 it was the household balance sheets in US, 2011-12 it was the government balance sheets in Europe, parts of Europe. If you see the last, I mean the financial crisis in Asia earlier, or the recent one in India, it was a corporate balance sheet. In any balance sheet, regardless of the lower base, when the growth is much faster, much faster than the income growth, it will lead to some trouble, because when a lot of money chases a particular sector, underwriting standards get diluted, some of the practices come in, and that leads to some trouble. That's why I keep repeating, I think those who have maintained their balance sheet well and have a very high level of I would say extremely prudent risk management, I think they would do well. Particularly on the bank side, so you mentioned about some of the retail banks. Yeah, the so-called corporate banks also have a massive retail franchise.
Let's not forget that.
They have strong CASA on liability side. Their ability to raise liability even other than CASA is huge, and they have a large retail franchise. Last few years, some of these banks had their own set of challenges on the stressed asset side. Now as that gets resolved, I think they will focus on retail. So I think some of the market share from the NBFCs is likely to shift back to the banks.
Okay. Buffett also says that interest rates, they act like gravity, and if interest rates are going higher, valuations will come down, demand will come down.
Yeah.
Are we likely to see a reversal in demand, auto demand, consumer demand, discretionary demand, because interest rates have not gone up by 20 bips, they've gone up by 150 bips already in the system?
So we are yet to see the full impact. I think it hasn't really passed through completely to the consumers yet, but I think they will have impact on both. I think on the corporate profitability, last quarter was good and people started extrapolating that, but I think the higher raw material prices, which will also get impacted by the weaker rupee on the margin side, and also the higher interest cost, it's going to impact for sure. For the consumer lending, I think the rates are likely to go up. If you look at today the marginal rate of borrowing of most of the NBFCs, and you look at the lending rates, I mean lending rates are lower than their marginal cost of borrowing. So I think the borrowing rates will go up and will have at the margins some impact on some of those segments.
I'm going to quote one of our old interviews, and you mentioned that markets, they always follow cycles. There is a leadership, there is a boom and there is a bust, and that's the beauty of the market. So where do you think right now there is going to be a change of leadership? Because up until now it's been NBFC, consumer names, a little bit of consumer discretionary, which has really led the party higher. Next 3 years it may not last. So what will come up again?
I think it will become more broad-based. So India is going through a couple of cyclical challenges. I mean, particularly on the external side, if you look at the world getting impacted by trade war, getting impacted by the monetary tightening. Today, Federal Reserve is likely to raise rates further. It will be the first time after 10 years will be above 2%, above inflation. Will be impacted by the crude oil prices. In the near term, I think will remain under pressure, and then you have a heavy political calendar. But you look through a year, and then let's say 2020 and 21. Once I think, let's say the resolution of the corporate side, the challenges on the corporate balance sheets have got deleveraged, massive deleveraging is happening. Once banks are in a better shape to lend, the overall economy from a low base, the last year's disruptions on account of demonetization or GST, etc., the growth comes back on track. The growth will become a lot more broad-based. One interesting thing that has happened is, while structurally one can still argue the connection between the rupee and the exports, but I think a weaker rupee is also helping some of the sectors which are not doing well. So you are seeing in the market exactly. So I mean, you are seeing the IT, you are seeing pharma, you are seeing some of the import substitution like metals, etc. You're clearly seeing the positive impact of that. I think as growth becomes more broad-based, I think we'll have a lot more choices. As we discussed at the beginning, look at the market this year. I mean, there are few stocks. Somebody messaged me yesterday that there are almost more than 50% stocks have fallen more than 20% this year when we were at the new high in the market, and then there are some 8% stocks which have delivered more than 20%, and there are some 17-18% stocks, listed stocks, which have fallen 50% plus. So it's been a extremely narrow rally. May continue like that for some time because of the macro challenges that we have, and some risk even at the micro level where the numbers have been good for last few months. But structurally, I think 3 year I look at, I think this is likely to become more broad-based.
So good news and good prices don't come together.
Never.
Right now,
how can you have
our price is good?
Exactly. I think in a lot of places there has been decent correction. The market always work like a pendulum, and for 3 or 4 years we discussed almost every year, and I said that given the disruptions in the technological disruptions, the consumer behavior disruption, the disruption caused by GST, logistics, the disruption caused by the way of doing business is changing, will lead to a situation where the smaller and mid companies will do better than the large guys, and which played out very well for 3-4 years. But the valuations reached another extreme, and that's why at the beginning of the year our view was that it's going to be a year of the large cap. I think the correction, there has been a decent correction in the mid and small cap space, and there is a time to actually do a bottom fishing there.
Okay, so let me ask you a very simple question, and this is just meant for our average retail investor. Should you now at these levels start at a 5-year SIP in a large cap fund or a small cap fund or a mid cap fund?
Anything above, actually multi-cap is the best place, or the category called large and mid-cap, where you have ability to put money across market capitalization. See, there are a lot of sectors in India where the largest companies are small cap or a largest mid-cap. I think a multi-cap fund is very good.
That's a hedge dance.
Okay, so if you have a risk appetite, if you can see the volatility that we have seen in a small and mid-cap, I think ability of bottom-up stock picking in India in the small and mid-cap segment is still very large. Large number of new businesses are yet to be listed. I would still put, if I'm putting more than 5 years, at least 5 years, I would still keep an SIP in a small cap or a mid cap fund.
Okay. Now Ray Dalio, told us when we interacted with him last that markets, they follow cycles, and all you need to do is just figure out when was the scenario, when were the circumstances similar, and what happened when these circumstances played out. So what does the current economy remind you of? When did we see this kind of a situation where crude was high, rupee was weak, and valuations were also high? Because in 2013, crude was high, rupee was weak, but mid-cap was very cheap.
Roger, yeah.
It's a different scenario.
So since you talked about Ray Dalio, you have this very beautiful 3 words. Pain plus reflection equal to progress.
Exactly.
Every time you have
you've read the book Principles. Yeah, it's a good book. It's a very good book.
We have seen some bit of this pain. I think if we reflect as a macro, as policy makers, as let's say whether you are a corporate running a business or an investor, what are the mistakes that we have made, and if we reflect on that, I think that means we will be better positioned. I think as you rightly compared that in 2013 when we had those challenges, right from the policy paralysis to very poor macro, the valuations were cheap. But if you think about it, at that point in time, the expected earnings growth was also, like, of course, very high in that time. and then the expectation was that next 3 or 4 years we are going to have a massive profit cycle. That hasn't happened. It has been very, very narrow. My sense is that despite the next 1 or 2 quarters, the challenges that I talked about on the margin side, on the revenue side, and some of the challenges, for a 3-5 year, I think the corporate profit growth is likely to go back to the more normalized, maybe in line with the nominal GDP
What
growth.
will lead this profit uptick?
I think one of the biggest is this stress asset resolution. Think about it. I mean, the largest bank in India, just see the size of the balance sheet. If it gets to a normalized 1% return on asset, just think about it, how much nifty earnings will get impacted by them. Similarly, like all people wrote off a year back the IT sector or some of the exporters, but now with the weaker rupee, of course, it's not a sustainable advantage, but at least in the near term there is an advantage. And if the global economy is doing well, US is in a good shape, corporates are doing more capex, as of now more on the digital side, but at some point in time there would be other capex as well. I think it will help the rest of the corporate India as well.
How do you propose one should bet on consumers? Because we had a chat in 2013 and you said, "Bhai, hum to consumer pe bet kar rahe hain," because India is all about consumers. What is the best way to align with consumers right now?
So the structural story hasn't changed at all. Then you are starting from like $2,000 per capita. Abhi to rupee week ho gaya, back to maybe $1,800 per capita with the youngest population, with an aspirational middle class. You are going to do premiumization, and consumer companies with the help of digital technology, etc., are able to cut cost, and you are seeing higher margins. But as you said, good news is not a good price. Look at the stocks and the valuations; they are like so high. And
So you don't
worried.
own consumers at all?
No, we own consumers. So you see on a relative basis where the valuation comfort is higher, both on the staple side as well as on the discretionary side. The structural, and there are variety of plays. I mean, I'm just giving you a small example. Maybe like, let's say if the tourism goes up, India has to focus a lot more. We have a structural problem on our export side, manufacturing exports. We can't increase. We can't compete with the giants of China, Taiwan, Korea. I mean, look at even Vietnam and Bangladesh. The only way we can get revenues is the tourism. And look at the hotel industry and the market cap. Can it become bigger? It can become bigger. So there are variety of ways to play the consumer.
Okay. Now, it's, last 3 years the narrative has been very simple. Interest rates are low. Alternates are not doing well. Real estate is in a downtrend. Gold prices have been flat. Jao SIP chalu karo. Right? Fixed deposits now, with some banks, they've started offering you a rate of 7 to 8%. Do you think in next 12 months, the biggest fear for equity market could be that fixed deposits will start competing with SIP returns?
So I think that if people thought there is only one asset class, equity, that delivers the best return, I mean, that's unlikely to change. Equity would deliver good return over a longer period of time, but fixed income will also look attractive, is looking attractive. So particularly we have been telling investors that this is the time to also think about the SIP in fixed income. I mean, my parent generation used to do recurring deposits. You will remember that, post office, banks and all that. We have grown recurring deposits. Time has come to do that recurring deposit in fixed income funds. You don't have to take credit risk, you don't have to take too much of duration risk. You just put money in, let's say, short-term fund, which is not taking too much of duration risk, too much of short-term risk. Rates are so attractive, even in a good quality PSU bonds.
But when you have an INFS issue or a JSPL issue, it in a sense shakes you.
That's what I said. Again, I think, look at the size of the industry and the extent of the problem. I think industry doesn't get as much credit the way it has managed credit for last 25 years and last 5-7 years. There are 10 lakh crores of assets which are under stress with the banking sector, where there are thousands of credit analysts, and most of those names there is hardly any exposure by the mutual fund industry in these names.
I met a mutual fund CIO earlier in the week, and the communication which I got from them was, go for debt aggressively, because next 12 to 14 months equities may not be safe at all, because you have elections, valuations are not great, and crude is going to be a problem. Would you like to change what he's communicating?
So I heard the same, if you remember, I heard the same in 2013, because rates were higher, equity is not looking good, it's a time to win that. You can do that 1 year. But in 1 year, let's say what happened, equity markets went up substantially higher, particularly on the mid and small cap space, and you have a reinvestment risk. As I mentioned earlier, you should surely look at fixed income. Fixed income is looking very attractive given where the rates are, and they may inch up higher in the near term. It will become attractive. At the same time, if your money is putting money money for 5 years, 10 years, 20 years. And I think in India, still people keep thinking about next 1 year and how do I allocate. This is not the way to allocate money. You have to think longer term. Maybe if you have a tactical allocation, I agree with you. Maybe in the very near term, fixed income looks good.
You thumbed the table in the month of Jan and said sell small cap stocks. There is a bubble or there is a crash which is coming. Right now, if you have to thumb the table and say that there is value in this market. Now, markets may not recognize that for 1 month. Markets may not recognize for 3 months. Markets may not recognize that for 6 months. But where do you think as a fund manager you're convinced?
So with this fall, we have seen some of the large caps becoming mid caps and some of the mid caps have become a small cap. I think India is a stock picker's paradise. I mean, if you identify stocks across the market cap, I think with this sell-off and every time when there is indiscriminate selling because foreigners have their own set of challenges, I think if you play your time arbitrage well and take a slightly longer term view, I think value is emerging. I won't say that just sell your house and put all the money in equity today. Today is the time, may or may not be. Given the macro challenges both on the global side, domestic side, the political calendar, some of the other challenges that I talked about. But I think if you look through that and put money over the next few months, I think you'll be rewarded well.
Why is crude misbehaving itself? No one thought at the beginning of the year that crude will ever go above 60. $80 and the Arabs are saying that we are happy with it and we are not going to be increasing production.
So Nikunj, if you remember when Trump came and I said that Trump has 3 agendas: tax, trade and Tehran. And he has a tool which is also one other tool which is Twitter. There's a couple of T's there. I think he did the first was the tax, then I think trade, and he's serious about it. And I think the world
doing everything on Twitter now.
And I think he's serious about Tehran also, and it will impact the world. It will also impact India maybe relatively more. I hope that probably he goes a little slow on that third T, which is Tehran. But if it does that, if sanctions are going to be harsh than what the market believes, what the commodity traders believe, then we have some issue in the short term. But structurally, you think from an OPEX perspective, the higher they keep the prices for longer, it's negative for them. That means more money going into the renewables, more money looking for alternatives to the fossil fuels, which is not good for them.
There is all this shale gas.